Welcome back. In this session, we'll conduct a comparative analysis of three popular financial instruments: bonds, shares, and money market funds, MMFs. By the end, you'll understand their risk-reward profiles, how they align with different investment goals, and which timelines they are best suited for. Let's get started. Bonds versus shares versus money market funds. Let's begin by briefly defining each instrument. 1. Bonds. A bond is essentially a loan you give to a government or corporation in exchange for regular interest payments and the return of your principal at maturity. Example: treasury bonds issued by the Kenyan government. 2. Shares. Shares represent ownership in a company. By purchasing shares, you're entitled to a portion of the company's profits, dividends, and potential capital gains. Example: buying Safaricom or Equity Bank shares through the Nairobi Securities Exchange (NSE). 3. Money market funds, MMFs. MMFs are low-risk mutual funds that invest in short-term financial instruments like treasury bills, fixed deposits, and commercial papers. Example: investing in a CIC or Sanlam MMF. Risk-reward profiles. Every investment comes with its own risk and reward balance. Let's compare these three. 1. Bonds. Risk: low to moderate. Government bonds are safer than corporate bonds. Reward: moderate, with fixed interest payments over time. Ideal for investors seeking stability and predictable returns. 2. Shares. Risk: high, prices fluctuate based on market and company performance. Reward: high potential returns through dividends and capital gains, but losses are also possible. Ideal for investors with a higher risk tolerance aiming for long-term growth. 3. Money market funds, MMFs. Risk: low, investments are in secure, short-term instruments. Reward: lower returns compared to shares and bonds, but higher than a standard savings account. Ideal for investors prioritizing liquidity and capital preservation. Investment goals and timelines. Your investment choice should align with your financial goals and how long you're willing to invest. 1. Short-term goals, 1 to 3 years. Best option: money market funds. Why? They offer liquidity and low risk, making them perfect for saving for emergencies, school fees, or a vacation. 2. Medium-term goals, 3 to 10 years. Best option: bonds. Why? They provide stable returns over a fixed period, making them suitable for saving for a home or a child's education. 3. Long-term goals, 10 plus years. Best option: shares. Why? The potential for high returns over time makes shares ideal for retirement savings or wealth accumulation. Key considerations for choosing between the three. 1. Risk tolerance. If you're risk-averse, stick to bonds and MMFs. If you can handle market volatility, consider shares. 2. Return expectations. For predictable, stable returns, bonds are ideal. For higher returns, shares offer more potential. MMFs balance safety with modest returns. 3. Liquidity needs. MMFs are the most liquid, followed by shares depending on market activity. Bonds typically have the lowest liquidity due to longer lock-in periods. For diversification, combine all three to balance risk and maximize returns. For example, use MMFs for emergencies, bonds for medium-term security, and shares for long-term growth. Bonds provide stability and steady returns. Shares offer high potential returns but come with higher risks. Money market funds prioritize safety and liquidity. The key is to align these instruments with your personal goals, risk appetite, and timeline. A balanced investment strategy often combines all three, ensuring that your portfolio can weather market changes while meeting your financial needs. In our next session, we'll explore practical strategies for building a diversified portfolio that incorporates these instruments effectively. See you then.